Welcome to this week's Money Metals podcast, helping gold and silver investors during these treacherous times. Now, here's this week's market wrap with commentary and analysis from the company voted 2015's Precious Metals Dealer of the Year in the U.S., Money Metals Exchange.
This is Mike Gleason with Money Metals Exchange, and it is my privilege now to be joined by Michael Pento, president and founder of Pento Portfolio Strategies and author of the book, The Coming Bond Market Collapse, How to Survive the Demise of the U.S. Debt Market. Michael is a money manager who ascribes to the Austrian School of Economics and has been a regular guest on CNBC, Bloomberg, Fox Business News, among others, and we're excited to talk to him again today. Michael, thanks very much for speaking with us, and welcome back.
Thanks for having me back, Mike.
Well, I definitely want to get into the war on cash with you here in a little bit, but first, you've been quite critical and outspoken about the Fed and its policies. So we've had an extended period of low interest rates and overall easy monetary policy, and at the end of the day, what has that gotten us?
Well, not much of anything. You know, the GDP has averaged 2.2% since 2010. I know the Wall Street carnival barkers would like to always exclaim that we are about headed to escape velocity in the economy, but there's been no increase in the rate of GDP growth since the Great Recession ended. And now the dangerous part is they're looking to blame the weather, snowier winters in the context of global warming, looking for any excuse to revise higher the first quarter, even though the first quarter has been higher than Q2 40% of the time in the last 10 years. But that's prima facie evidence that they should undergo some dramatic change to the formula that the Bureau of Economic Analysis conducts. So the danger here is I think we're going to get more and more government data that's manipulated right from the onset of its release.
Ultimately, what do you think the market's reaction will be to all of this? Because it seems like it would have to unwind at some point, right?
We're in an epic bubble. I mean, if you look at the Q ratio, which is really the total market cap divided by the replacement cost or book value of companies, that's virtually at an all-time high outside of 1999, early 2000. If you look at the total market cap as a percentage of GDP, the same story. We're 127%, where the median is at 88%. If you look at the median PE ratio on the S&P 500, it's higher than 99% of all other occasions. So we're in a monstrous bubble in equities, and this is not only the United States, that extends especially to China and Japan. Of course, in Europe, we have negative real interest rates and sovereign debt across the globe. We have negative nominal rates in even Portugal, of all places. And the Portuguese had a 6-month T-bill trading at 11% in 2011, which was actually the vote on the part of the bond market that Portuguese people, the tax base, was incapable of servicing Portuguese debt. So interest rates spiked to 11% for very short-term debt. Now, because Mario Draghi came in and uttered the phrase, whatever it takes, guess what? Yields in nominal terms are negative. So you're looking at a massive bubble in stocks, a massive bubble in real estate, a reignited bubble there, but also an unprecedented global international bubble in sovereign debt. And when that pops, it's going to make 2008 look like a walk in the park.
What does this mean for gold? One would think it would generate more demand for it, no?
They just had a report yesterday that I think it was 6 banks across the planet were fined billions of dollars for manipulating LIBOR, the London Interbank Offered Rate, for manipulating currencies, for manipulating S&P mini futures, for manipulating everything, and that included commodities. So gold is a very highly manipulated commodity because it reveals the fact that governments are insolvent and their currencies are worthless. So there's a vested interest from governments and financial markets to keep this metal down. But if you're moving towards a cashless society, and I know you wanted to get into that later, but if you move to a cashless society, I think you have such an overwhelming demand for gold from the private economy that it would overwhelm and supersede any type of manipulation from banks and governments.
Has the lack of safe haven buying of gold to this point surprised you a little bit, Michael?
Yeah, matter of fact, it has. I'm so surprised by so many things, Mike. If you told me that the debt of the world would explode by $60 trillion since December of 2007, if you told me that nominal interest rates were going to be pushed to zero by central bankers across the globe, I have to add also, if I told you that every central bank on the planet has adopted inflation targets, I would have told you that gold would be, $2,000, $3,000, $4,000 an ounce. But like I said, because it's manipulated, it's been artificially suppressed down here for much longer than I believe. But I guess that's good news because people who want to buy it can buy it much more cheaply. But that won't last for long, in my opinion, especially as the confidence in central bankers finally erodes and withers away to zero.
The war on cash is something we've been covering over the last month or more as things have really been heating up on that front, and I know you were quite concerned about what's happening there too. What are government officials and central bankers attempting to do here by giving people zero or negative interest rates at the same time they're trying to herd them into holding cash in the bank? Well,
what they're trying to do is they're trying to get an inflation target reached. And it's been difficult for them to achieve this inflation target. First of all, the way they measure inflation has been so convolutedly changed since 1980 because of the Boskin Commission, and I don't want to get into much of the wonky weeds here by describing to you how they undercalculate and underestimate the rate of inflation. But the rate of inflation should be much higher than it is today if you calculate it in real terms. But what they want to achieve is a 2% inflation target. They have a 1.8% inflation if you look at the core rate, because oil prices collapsed, now they're down to barely a positive year-over-year change in consumer price inflation. But here's the thing. They want to get inflation much higher, and the reason why I believe they want to get inflation higher is because they know that the nation is insolvent, not only the United States. I'm talking about China, I'm talking about Europe in general, and I'm talking about Japan especially. So in order to make these government payments solvent, they're trying to engender a massive amount of inflation, much north of the stated 2% target. Now, the only way they can do that is by expanding money supply, and that's been very hard to do under the current laws that are in place because a central bank cannot directly monetize government debt. They have to use the private financial institutions as a conduit. So what they've done is they've taken interest rates down to zero. They've engaged in massive quantitative easing, but the consumer is what I call debt disabled. Their debt as a percentage of income is still way above historical measures. It's about 88%. It's usually around 40%. So what do they come up with now? Negative nominal interest rates. Now, if I told you that your deposit rate would be minus 0.01%, you might not care. If you have $1 million in the bank or even just a couple $100,000 in the bank, you might say, well, you know what? It's not very convenient and very risky for me to put all this cash under my mattress. So I'll keep it in the bank at slightly negative interest rates. But if banks took the interest rate, the nominal interest rate, not after inflation, the nominal interest rate to minus 10%, what would occur? I would take all of my money out of the bank immediately because I'm not going to lose 10% of that value. I'd rather hire an armed guard to patrol my mattress. It'd be cheaper. So what they're headed for, what they're trying to do, is go to a cashless society. And if you have a total abandonment of cash all over the globe, it prevents you from doing that. It prevents you from taking your money out of the bank. You can't take money out of the bank because it will all be electronic. And then they can take total and absolute control of the money supply. They can make interest rates as negative as they choose. And in that case, money would become a hot potato. You would have to spend it as soon as you get it. The money supply would boom. Of course, if I'm getting a negative 10% on interest, then I become very much favorable as a borrower as opposed to a lender. So you'd have a massive increase in velocity and a massive increase in money supply. And then you have the real problem because inflation would run way out of control. And the only way you can preserve your wealth in that case would be to hold precious metals.
Expanding on that, you touched on it there, but what should the average person who is listening to this be thinking about? I mean, where are they going to go for financial safety given all of these headwinds?
Before I go into that, I just want to tell you that because of the condition of the economy, I will tell you that you can't go and buy sovereign debt. 24% of Americans have more credit card debt than they do savings. This has become a part-time economy. There's 2.5 million more part-time workers today, and there's 2.2 million less full-time workers. So the middle class is being completely eroded. You can't buy sovereign debt. You can't go into the stock market because, as I laid out before, the Q ratio, total market cap to GDP, median PE ratios at sky-high valuations. Not only that, but the underlying earnings and economic growth, as anemic as it is all fictitious. It's based on 0% interest rates. So for my money, you have to have a strategy that both hedges against inflation and deflation. You want to own commodities. You want to be short certain markets. Certainly I'm short the bond market. I'm long certain economies. I think Russia is a good buy down here with very low PE ratio. And other than that, you have to be very nimble, very quick, and you have to understand that the economy on a global scale will have wide swings between inflation and deflation, and you have to hedge for both.
Well, excellent stuff, Michael. We really appreciate your insights, and thanks for being so generous with your time. It's always great to talk to you, and I hope we can do this again. Things figure to get very interesting down the road.
Thank you, Mike.
Well, that will wrap it up this week. Thanks again to Michael Pento of Pento Portfolio Strategies. For more information, visit pentoport.com. That's PENTOPORT.com. And then, of course, check out the book. It's available on Amazon, The Coming Bond Market Collapse, How to Survive the Demise of the U.S. Debt Market. Tune in next Friday for next weekly Market Wrap podcast. Until then, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a great Memorial Day weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.